Banks are coming for yields, and they're coming for them in a new way as they start to challenge maybe the vault market. Well, today we're going to break all of that down with a special guest. I want to thank our sponsor today, and of course that is Uphold. If you are holding crypto right now and not earning rewards, you're essentially leaving money on the table. And the reality is, in today's market, you need to be able to move instantly. That's why Uphold's flexible staking is such a game changer. You can earn weekly rewards automatically on assets you already hold without a lockup. That's most important. You can sell anytime. It's the perfect setup for anyone who wants to grow their holdings without losing their exit strategy. Download the Uphold app today and try it for yourself. And let's just get started. I want to bring in son Raghupathi, who comes in as the CEO of Veda. You guys have seen Veda out there. So how are you, son?
Doing great. Thanks for having me, Paul.
Excellent. So first up, I want to hit on it for some of those that don't understand Veda. Before we even show TVL, I want to kind of learn a little bit about what you guys are doing in the market. Where do you find your place?
Yep. Let's maybe start with the question of what vaults are. I think that's central to everything we're going to talk about.
Mm-hmm. Yep.
So we've seen an evolution of financial products over the past few decades, from funds to ETFs, right? And vaults are the next progression of infrastructure for financial products. So a vault is a way of packaging up different kinds of tokenized assets into a single consumer product that people can very easily deposit into and withdraw from and target a specific risk return profile. So think of vaults as infrastructure for creating new financial products on crypto rails. Where Veda enters the picture is we are a platform for creating vaults. And so we provide the infrastructure layer that asset managers, curators are this term that get used in crypto, fintechs, anyone who wants to offer their customers exposure to on-chain yields can use our platform to build products that meet their customers' risk return needs.
What would make you different than, say, something that Morpho and Steakhouse Financial are doing when it goes into, putting your assets to work for yield, mostly in the credit market?
Yeah, great question. Let's start with something like a Morpho, which is an on-chain lending protocol, right? You can think of it as a credit network.
Yeah.
So Morpho creates markets on-chain that different borrowers and lenders can come to and transact with each other, right? And it's doing all of this in an on-chain native way. So Morpho is actually one of the yield sources that Veda vaults can tap into, but there's a much larger universe out there. When you look at the trend of tokenization, where you're taking things like treasury bill products, cash products, private credit funds, right? The whole universe of assets that currently live off-chain but are moving on-chain, that sits outside of lending protocols like Morpho. And These are the kinds of products that can go into a vault built by Veda. So think of Veda as neutral infrastructure that can access credit markets from Morpho. We can access RWAs. Anywhere where you find on-chain yield, our infrastructure can give you exposure to that.
Son, do you think that we are dealing with a sophisticated enough investor now to where they can really understand vaults in general, at least in the early stage? And how quickly do you think we'll see uptake, adoption in the next year?
This is a more philosophical question, even just thinking of crypto and DeFi and the on-chain world. What we're seeing with on-chain finance is a lot of the technical details are hiding behind the scenes and being abstracted in normal consumer and institutional experiences.
Yeah.
And so this is just a broad trend. So, when you ask the question of, do people understand vaults? I don't think consumers understand vaults. And frankly, I don't think it's really important for them to understand vaults at a deep level. But it is really important for the institutions and the enterprises that are using this technology to build consumer products. It is super important for them to understand it. And I've been very, very impressed over the last 12 months with how quickly traditional institutions have started to really grok this technology. The largest banks in the world, the largest asset managers are all extremely excited about vaults, and they understand it far more deeply than you might expect.
So to put it into deployment cycles, because everybody looks at, well, how fast you see uptake. Obviously, we'll talk a little bit about clarity because you have banks forming a very interesting conglomerate now. We'll talk about that as well. Before we jump to that, just to look at the TVL, this is a Veda right here just over the last few months. June into where we're running. Obviously, there is some movement upwards on this. The likelihood, though, of what we'll see in the coming months, Morpho still leading when you look at Vault infrastructure, Morpho still kind of at the top of the heap, but you guys right there behind them. What's the opportunity here in terms of a market? If you look at total addressable market for any major product or project that's out there, something like a Veda, where will you guys be in a year?
Let me start at the end game of vaults, and then there's path dependence for how we get there. So vaults, again, are the next generation of asset management. It's what happens when you take asset management and you build it in an on-chain native way, which means it's cheaper to create products, it's better UX, it's higher yield because you can build more interesting products. So I fully believe the trend of progress is going to be all of asset management moving on-chain through vaults. And that's a multi-trillion-dollar market. That's hundreds of trillions of dollars.
Right.
But that's the end game. Maybe that's 10 years, 20 years away, right? Now, in the short term, where we're seeing the most adoption in this category is actually with fintechs. So these are companies that have stable coins and they have global user bases who are sending money around, right? They want to save in dollars. And so vaults have emerged as a really powerful tool for offering those global users who previously maybe haven't had exposure to like great assets, even to US dollars, frankly, and giving those users a way to earn yield. And so that's what most of the growth in the category has been. These are users who can't just, buy US treasuries off the market, right? Like they don't have traditional financial infrastructure. And so stable coins with vaults following very closely behind allows anyone in the world to have an on-chain savings account where they're earning good yield. So that's the short term. In a year, I expect a lot of growth in this category. Some of the largest fintechs on the planet are building vault products today. And so I expect to see multiples in growth, but the bigger picture really is where trillions in AUM exist is in traditional finance, and upgrading all of those products is really the long game for this category.
What about, you look at, obviously we'll talk about the Kraken partnership and I want to learn more about that, but when you look at something that even Robinhood is doing right now, they're offering their stablecoin USDG with these unusually high yields right now. I think it's 7% in the app. It's putting it to work through, the channels of Morpho and Steakhouse Financial, et cetera, to be able to yield that. They tack on, I think it's a Lloyd's of London insurance policy, so there's kind of a pseudo security blanket there. Do you think that kind of activity is going to put pressure on vaults, especially when you see those kind of yields coming in?
Yeah, so that product is a vault product, right? This is exactly the kind of product that there's universal demand from. Now, 7% is really high, right? Like there's sort of no free way to get those yields. It's either going to be some form of marketing subsidy, or users are taking a little more risk to get that return, right? And so I think what's really important is that different fintechs, different companies, different user bases all have different requirements for risk return. There are users out there on fintechs, not on Robinhood, because Robinhood has great investment products, but take payment companies that specialize in cross-border remittances, right? Their users are earning nothing, and even giving them access to a money market fund product through vaults is an infinite improvement, right? So I think Robinhood is one sort of market participant type. It's an archetype, right? These are sort of brokerages who have tons of assets on platform, and they need really differentiated products for it to move the needle. 7% is a great way of differentiating, but I don't think that's the whole market, right? There's just so many different types of players who benefit from this technology.
How quickly, Sun, do you think we'll see it in something like a Revolut, a SoFi, those kinds of products that are out there that aren't, full-fledged banks, kind of a neobank layer to traditional finance? How do you think they'll make it first, or do you think the efforts of the banking industry might get there first?
Yeah, I think neobanks are already there, frankly.
Yeah.
Right. Some of the largest users of Vault today are neobanks, and the big dogs are going to be doing this very quickly. It's a very intuitive, right? Fintech moves a lot faster than TradFi. We're going to continue to see that play out, but I'm sure you agree, right? This creates a lot of pressure, right? Banks are clearly very concerned with yield. This is why it's central to the issue of clarity, and vaults are that core primitive for generating yield. So I fully expect to see TradFi move faster as these products gain adoption in fintech, because that's an existential risk to them.
Yeah, for sure. I want to play a clip off the Tokenized Pod. I think you responded to this clip, and it's talking about vaults because you're looking at a risk versus reward. And I think this is something that even, sophisticated investors will start to question. Let me go to that clip.
I think that the big question is how you scale the actual collateral forms in the ways that these vaults function over time. And it feels like a lot of the early iteration of what's behind these earn products and vault products, it's basically CBBTC. It's Coinbase's Bitcoin as collateral.
I'm not very relaxed when I see this phenomenon. Even the super safe version, I'm pretty sure that if you could choose, are you going to give money directly to the government for 3%, or are you going to invest in a permissionless, over-collateralized BTC margin lending vault curated by an unknown entity for the same amount? What would you do?
All right, so you had a response on that. And just to show people kind of the comparing yield volatility with counterparty risk, these are some of the examples right here. And looking at treasury bills there, like up to 3.5, low risk, very low counterparty. You can see the rundown, even down into money markets right now at around 5% at the high, very low counterparty. But then you get into staking on USDC, staking on Bitcoin, staking on Ethereum, all of these starting to layer in much higher yields. There's a lot more risk on this. So risk to reward. Sell me on this one, son.
Yeah. So love that clip. I think there's a lot of truth in that, right? The spirit of this is that some of these vault products, some of these DeFi products don't even materially get you higher than the risk-free rate in government debt and treasuries, right? And so there's a really valid existential question. Should those products even exist? But I would actually argue this is a false dichotomy. It's not like one is strictly better than the other in all ways. So as an example, yes, you could argue US treasuries. For many people, it's like the perfect product, but most people in the world don't have access to US treasuries, right? If you're someone in, Venezuela whose currency is just going to zero, right? And you don't have dollars, you clearly don't have traditional banking infrastructure, US banking infrastructure to be able to access treasuries. You're not deciding between these two things. You may only have the option of getting a low yield, highly liquid savings account built on DeFi infrastructure. And so that's one sort of response to this. It's like, this is a totally false dichotomy. For the people who have access to great assets, some of this stuff doesn't matter. But billions of people in the world do not have access to good assets. And what we're building here in crypto, in DeFi and on-chain finance, is a way to bring good financial products to the rest of the world. Okay, so that's one point. The other point I'll make is that I see these things as two different asset classes. So everything that's happening in on-chain finance with these on-chain native lending protocols, lending against Bitcoin, which is what Kai was talking about in that clip, that is a different asset class than something like a US Treasury, than something like a traditional credit fund. And we're going to see the lines between these things blur over time as more of those traditional products move on chain, right? And so I totally reject the idea that, traditional finance is already meeting all of the needs for people and these products provide no value. I think there's risk involved, but at the end of the day, people don't have access to good assets. What we're doing here is we're trying to bring billions of people financial, exposure to good financial assets.
What do you make of the announcement? We had the Bank Chain Alliance formed, 39 U.S. state bank associations now launching this. There's almost every major bank out there, including JP Morgan, who also is trying to launch a stable coin. All of this in timing with the fact that we've got the Clarity Act coming up, hopefully in September, whether we get a vote or not. But it's clear that the banks are moving forward. How much of an impact does this have in the structural framework of how they're going to build to compete with products like Veda?
Yeah. First of all, I think this is amazing, right? Like if the only outcome of what we've all done as an industry is we have forced incumbents to innovate and give their customers better products, that alone is worth the effort, right? I also think this means there's a large opportunity for infrastructure providers in the space like Veda because the customer base has evolved drastically over the last couple of years, right? It has evolved from DeFi native, crypto native protocols, and at best, very innovative exchanges like Coinbase, to now your customer base can be traditional institutions who have millions and millions of users and potentially trillions of assets. I think this is really exciting. I'm excited to see more competition in the space. I think, banks and TradFi institutions have advantages and disadvantages. We'll have to see who wins, but I'm excited to help everyone who's interested bring their assets and their customers on chain.
I want to bring in Senator Lummis, a clip from her, because this gets into the point that you're kind of making here, is that TradFi has finally woken up to this idea and maybe is trying to get the rules of the game changed a little bit. Let's go to that.
The banks want changes to the Genius Act, which was the stablecoin bill that passed last summer. They want the changes in the Clarity Act. And so they've been working hard on the Republican side of the aisle to scuttle our bill until they get what they want. Now, Senator Tillis on our side and Senator also Brooks, they came up with a compromise with the banks, with their lobbyists. The banks later fired their lobbyists and now want a do-over because they didn't get everything they wanted.
All right, so there you have it. Banks now starting to flank around this, coming into, I think, the comparison of where TradFi is going to be. Then you could also look at even what Commissioner Hester Pierce talks about, and she's getting to the point of that crypto vaults and on-chain lending strategies may fall under securities law. So this could change things dramatically as well. When you look at the positioning here from the SEC, you look at what the banks are doing and where currently vaults reside today, how do you think this is going to play out in the next few months? Because obviously September is a big month.
So the thing that banks are the most terrified of is paying dollar rewards to customers who are just holding dollars in their account, right? They think this totally undermines the value prop of banks. There are concerns about, how this affects general monetary, the monetary state of things. That is actually very bullish on vaults, in my opinion. Right? What vaults are is a way for people to productively deploy their assets on chain. And banks are not fighting against that. In fact, if banks have their way, this will be the only legal way to actually earn on idle stablecoins, is to put them to work.
Yeah.
So it's clearly, we could talk about this. It's like tales as old as time, right? Banks are protecting their interests. They're worried about this technology eroding their value prop. And they're free to do that, right? But there are alternatives. And crypto is always, our goal is always to provide access to the widest array of people. And so people are fintechs and, financial institutions are going to find a way to do that. So that's on the one hand, right? In terms of what the SEC is doing, this is not only inevitable, right? Paying attention to this category and trying to set some rules of the road, it is actually really good for the category. I can't tell you how many traditional institutions are really, really bullish on vaults and in the on-chain world in general, but they don't know how to interact with these products in a compliant way. And so getting answers to these regulatory questions, when are these securities? What are the requirements of the technology that differentiate one offering from another? This is going to open up the space 100x or more. And so I think the SEC we have today is one of the best equipped to do this job. And so I fully welcome more attention on this space because I think it's best for everyone.
So you have a lot kind of facing the SEC potentially, especially if the Clarity Act does not go through. Clarity Act now dropping down to 15% chance of probability for 2026. So that puts a lot of pressure on the SEC and the CFTC to do rulemaking. And with that in place, we'll kind of throw the political arena that is about to happen if the Democrats take the Senate, and what that's going to look like for crypto in the next 6 months, 12 months down the road. But one thing is for sure, the SEC and the CFTC are going to go to work. Where do you think they set up the guardrails for vaults based on a Clarity Act not going through?
What I would love to see, and for the record, Veda has been engaging with the SEC for the last 6 months So none of this is surprising. I think it's, again, great that they're paying attention, and they've been really willing to learn about this category at a deep level. What I would love to see are concrete rules about the requirements of the technology, right? Because here's the thing, people say vault to mean 100 different things. This is one of my biggest gripes with vaults as a category. You have vaults that are clearly just like hedge funds that are on chain and are absolutely should be, treated that way. And then you have products that are truly non-custodial, right? They have cryptographic guarantees for users, and nobody's taking custody on behalf of users or is taking discretion with assets. That's a very, very different setup, and it should be regulated differently. So this is the thing I would love to see. It's like, how do we classify these different products? How do we come up with a framework where you want to build a certain financial product and you know what the requirements are for who you want to distribute that to? And I think it's very plausible. This is one of our biggest goals. We're just here to, help and educate regulators. And I think they're doing a good job in understanding the technology.
So a couple of things to kind of compare, because I think a lot of our viewers are trying to figure out, what's the best route to take. I'm in crypto today. I'm starting to do things with these vaults, and I'm, loaning out my assets via Morpho. I've got things, that I'm playing with. You have DeFi hacks absolutely getting annihilated right now. They hit 942 million in TVL collapses. And then you look at in Q2, 85 exploits alone, 775 million in losses. This is the real concern. And I think to your point is that the fact that TradFi is now putting an envelope around these, kind of like what Robinhood has done. Bitwise has started to go in this direction. Fidelity, I don't know if they're there yet, but definitely Franklin Templeton and some others that are probably going to be moving in this direction. Very vault-oriented, structured capital that's kind of putting an insulation around these vaults. Do you think that is the track? And if it is, who's the next to move in really launching something innovative?
Yeah. So the DeFi hack point is really interesting. I think this is one of the biggest plagues on our industry, clearly. And these hacks are a function of having permissionless access to on-chain protocols that are managing, tens and hundreds of billions of dollars, right? And it's a function of that open access where any threat actor can come, and if they win your keys, they win the money. That's clearly not a sustainable equilibrium, right? There's interesting questions with AI creating load on cybersecurity and what agents mean in this question. But I think increasingly we will see guardrails form around this in the form of more permissioning. It's just how it is, right? The dream of DeFi was anyone can use whatever you want. If you can ring fence these things and you know who's transacting, that adds some safeguards. Okay, in terms of who's moving next, the big asset managers have been very, very actively exploring the space, but they have not entered yet in a meaningful way, right? They're tokenizing their funds, they're moving them on chain, but they have not yet distributed those funds through vaults. So that's what I see as the next big unlock here. It's you have all these users coming on chain through fintechs, right? They're holding stable coins, they want yield. And you have all the asset managers on the other side of this sort of marketplace that's forming who are issuing funds and issuing tokenized assets on chain. So vaults bridge this gap, right? They allow people on fintechs who have stable coins to get exposure to this growing universe of on-chain products. I'm really excited about that. I think this is going to happen over the next 6 months. Veda is doing a lot of work in this category. We're working a lot with different asset managers and issuers to enable distribution through our vaults. So I'm excited about that. Beyond that, what's a huge opportunity is getting these products into regulated channels like brokerages, right? And that's a big challenge. It's going to require regulatory clarity. It's going to require buy-in from TradFi, but that's the $1 trillion opportunity. And I think we'll see meaningful progress in the next 12 months.
You look at a statement you guys made here, Bitcoin's market cap over actually it's more than that now, but a number that is more than twice the size of deposits at Capital One. Letting Bitcoin sit idle is a missed opportunity. Here's my question, because I feel like Bitcoiners, is in general kind of, I think they're the least interested in vaults, but tell me why a Bitcoiner, because I feel like it, the Bitcoin community seems to be very concerned about this, in the sense of whether a vault is and should be active with my Bitcoin. Do you think that, that idea is going to change?
There are two kinds of Bitcoiners.
Okay.
Right? There are the Bitcoiners who have put their hardware wallets, they have their Bitcoin in cold storage, they put it in a safe, and they put that safe at the bottom of the ocean, and their great grandchildren might be able to open it and get some Bitcoin. They don't want to touch it, right? And that historically has been the most vocal group who represent Bitcoin.
I would agree.
Bitcoin is, yeah, but Bitcoin's mainstream now. Like most of them, it's crazy, but most of my family holds Bitcoin. And this is not in like hard self-custody. It's through platforms that they trust. It's through the ETFs, right? And so Bitcoin has now gone mainstream, whether Bitcoiners like this or not. And there's a large number of people who would love yield on their Bitcoin, very simply, right? And so I think there is clearly an opportunity. There's hundreds of billions of dollars of Bitcoin sitting on these platforms doing nothing. And if you're one of those idealistic sort of like very opinionated Bitcoiners, you're probably not holding your Bitcoin on Coinbase anyway, right?
Yeah.
So there's just clearly an untapped opportunity. I don't think this is applicable to all Bitcoiners, but as this asset gets into the hands of normal people who are not ideologues, they're going to want to do finance with Bitcoin. And so yield is one of just the basic building blocks.
This was news that happened this week. We had BlackRock offering up now tender where you can basically convert Bitcoin into IBIT shares, the ETF, without a taxable event. So this is a big deal against capital gains. But the news was dropping from 25 million as the barrier down to 1 million. So anybody holding a $1 million Bitcoin out there in terms of portfolio could flip that right into IBIT. No questions asked, no capital gain. What kind of efforts do you think we would see from the industry if more ETFs are doing this? And would that have any impact on maybe the direction of where vaults might head with those kind of activities happening in TradFi?
Yeah, this is fascinating. I think there are implications here. If most of the world's exposure to Bitcoins comes from ETFs, that clearly has an implication on market structure, right? Now, my view, given that I've been building in this industry, is that it is always better to hold Bitcoin, even if it's on an exchange, than it is to get exposure through these wrapper vehicles. It's cheaper, right? You don't pay fees on it. You have a little bit more control, right? It's a little, you have more control over your own fate, right? I personally haven't thought through the implications of exposure to crypto being intermediated through these products, but it is interesting, and I think there is some bearing there.
Well, it's going to be something to watch if we start to see that playing out down the road. Let's look at future, next 3 to 6 months. I'll kind of zoom in on that. You guys have Veda's pipeline shifted to over 80% non-crypto native enterprises. And you kind of mentioned this earlier, is that you're seeing more innovation in TradFi. Explain to me what your next goals are right now, other than obviously onboarding a lot of these TradFi organizations for infrastructure, but what else?
Yeah, so top of mind is really getting more people on chain, more businesses. As stablecoins proliferate, and they are, it's just amazing. You can't find a fintech that isn't looking at stablecoins. And that happened so quickly, right, in the last 5 years or less. So everywhere that stablecoins go, that's sort of like a wedge, right? You start with stablecoins, you're able to hold and send money around the world. And the next question is, what do you do with it, right? You want to do finance with it. Maybe you want to access credit. Maybe you want to earn yield, right? And so this is the big opportunity. My goal with Veda, with Vaults, is to bring on-chain finance to every fintech on the planet, right? And I think that's actually a short-term goal, because stablecoins are just being adopted so quickly.
So fast.
So that's really what our 6 to 12 months look like. I still view it as a wedge, right? Traditional finance, getting the trillions of dollars that are currently on legacy rails onto better, more efficient, cheaper rails is the ultimate prize.
Listen, and I want to kind of get your opinion. I did a poll this morning. This was in reference to XMoney, okay? And it was simple. What would make you use it? And 1 was allowing stable coins. You had number 1. 2 was holding crypto, and then you had 25%. So basically 75% are saying they'd use this thing if crypto was engaged. I mean, this sounds like a phone call that you need to make to Elon.
I think he's bullish, right? He might prefer Doge over stables.
Yeah, there you go.
Yeah.
But I think that's the point, is you're going to see a lot of these, I don't know if you would call XMoney a fintech, but you might call them that now as they start to go in this direction. And I think we're going to see a lot more, companies kind of going
Absolutely
in this direction as well. So
yeah, this is fascinating, right? The financialization of everyday applications is something we will increasingly see, because everyone wants to be the everything app, right? Even if you're a marketplace or social media and you're doing payouts, right? You want your customers to stay there and live the rest of their financial lives. And stablecoins are a perfect way to do this. So I fully expect X to continue going down this way.
All right, Sun, it's been good having you on today. Thank you so much for coming in. We appreciate it.
Thanks, Paul.
If you like this video, hit like and subscribe, drop a comment down below, and also join our free private member group. The link is in the description.